Alright guys, welcome back to another module on the Da Vinci course, the Da Vinci program. And today we're going to be talking about accumulation and manipulation. Alright guys, and this is a very important topic for you to guys to understand, really just because in trending markets, this is what's going to be, you're going to see this phenomenon happen again and again. And it's going to be very difficult, especially if you're an intraday trader. This is more for if you're an intraday trader trading cable and fiber, but it does happen on a lot of pairs. This technique is very, very useful. All right, guys, because this is going to give you a framework to work around, to know when to look for buy, when to look for a sell, and it'll give you a framework to work towards, guys. So yeah, we're going to be talking about accumulation and manipulation today. So let's get through with it. Let's get on with it, man. So the best way to kind of understand accumulation and manipulation, guys, is through chart, candlesticks, and the bar chart. I think the bar chart's really good because it shows you more or less like what this looks like on a bar chart, and it literally, you can stay out. You can kind of like define what's really going on a lot better on a bar chart than you can on a candlestick, really. And essentially what the PO3 concept is, which is basically accumulation and manipulation, guys, what it's stating is that it's showing you where to expect the market to accumulate, to manipulate, and to distribute. And the market makers, guys, what they tend to do is that they'll push price below levels to accumulate it and manipulate it, and then what they'll do is they'll distribute price once they've finished accumulating it. So what we want to be doing is we want to be buying or selling when they are accumulating price, okay? We want to know when they're accumulating price and to buy within the area, because it's going to give us a higher success rate on our trades. It's going to give us a higher confidence level also, because we'll know when they're doing business, and that will mean we can make the most of that and get involved also. All right, guys? So I want you guys to study and understand accumulation and manipulation in terms of this bar chart. All right, so what is essentially going on is that the accumulation, guys, is more or less where the market makers are accumulating orders, above or below the market, more or less. That's what it more or less is. So in this situation, guys, the accumulation happens once price drops below the opening price on any given day or any given week or month. Okay, guys? So this, it's good to know that this technique usually will only work in trending markets. And that's because it's the way that price moves in a market. In a range bound market, guys, what price will tend to do is it will just run highs and lows simultaneously. Like, it's a different type of market condition. But when price is in a bullish trend, if you're an intraday trader especially, you will see this happen. And I'll go into some more details. We'll go to the charts later and I'll show you guys, how to see it on the chart also. But we're going to understand it first from a, definitive point of view. So the accumulation is happening when price drops below the opening price, okay? So in this situation, guys, this is more or less just a picture of a daily chart or a daily candle, and it shows you, if you know anything about bar charts, guys, it shows you the opening price here, and this is for a bullish day, the opening price here, the low of the day there, the high of the day here, and the closing price there. So what this is basically illustrating is, the open, the low, the high, and the close, and also the volume. So this is the trading day volume, guys, okay? So the way we use this information is that the market makers will accumulate price below this opening price. So what they'll do is they'll drop price below here to accumulate orders. And then what they're doing is building up their resources. They're building up their orders in the market to then later distribute it up the chain. Okay, so that's why you guys, the main difference between the way we trade and the way retail traders trade is that we are basing our trades off what the market makers are doing. We want to be buying when they're buying and selling and when they're selling. Okay, guys? It's the same concept here. We want to be buying underneath this accumulation level there, and we want to be selling once they are distributing price upwards. So in the up market, guys, what you want to see is, let's say this is the daily open. We want to see price drop below the daily opening price. And what we want to see is some sort of accumulation in this level. So That's either going to come in the form of price dropping down to take out a previous low, or like a previous day's low, or a short-term low, and then them accumulating orders that way. Or we want to see price drop below the opening price and into a bullish order block or a bullish breaker for these situations. Okay, guys? So it's one of the two. You know, I think the highest probability trades, guys, for this type of technique, for the PO3 concept, is when price takes out a daily low, or takes it turtle soups a daily low. If you see a stop rate in the morning, or you see a stop rate on a bullish day, right, it will usually mean they've dropped price below that opening price to accumulate orders below the market. And once they've done that, that means they've really fulfilled their, you know, that's where they're going to be buying. If it's a bullish day, they're going to be buying below the market, and then once price gets above, they are distributing. Okay, guys? So what that basically means is that once they've accumulated their orders there, what they're going to be doing is they're going to be distributing, in other words, selling off their orders as price rises. Okay, guys? So when once you see price expand really quickly, I know a lot of you have seen that happen when price just shoots up like out of nowhere. That's because the market makers have already accumulated price, and that distribution you're seeing is them selling their positions as price increases. So our aim, guys, simply is to buy below this opening price. Okay, that is the aim of the game, to buy below this in trending markets on bullish days, and to sell near the high of the day. Okay, buy near the low of the day, sell near the high of the day. And it's the same here, guys. You know, in bearish markets, if we had, let's say, we know that the order flow is going to be bearish for that particular day, we want to be selling price once it gets above the opening price. Okay, so once price gets above the opening price, we want to see it get above it, and we want to see some sort of accumulation indication here, guys. Okay, we want to see price start to either take out a previous day's high or take out a high or low. You know, even if it's an intermediate high or low, and we want to see it also come into a block. So it's one of the two, guys. Okay, we want to see it take out a high or a low. In other words, take out liquidity, or come into a bearish block or a bullish breaker. All right, guys. It's as simple as that, really. You just want to see those, one of those two price action telltale signs, and then what you want to see is you want to see it break lower, and then of course distribute. So our aim, guys, is on sell days when the market is bearish, we want to sell near the high of the day. We want to sell when price is above the daily open, and on bullish days we want to buy price below the daily open and sell near the high. Okay, guys, and that is more or less, that's more or less the concept of how this works. It's just understanding the phase that the market is in at that period of time. Okay, guys, when price is consolidating below it, you want to see an expansion. It's the same here. So what we're going to do now is go to the charts just to show you guys how this really works, and the best way to use it in your trading going forward. All right, so I'm going to go to cable just because this is probably a more obvious. This is a more obvious example, guys, and the reason why I'm saying that is because in this situation, like this day was very, very bearish. Okay, we had a very, very bearish week, guys, and that is why we saw price do what it did. So in this situation, guys, what happened is that we more or less got a very, very short-term stop run. Okay, so price came up to those previous highs, and what it did is that it ran those highs. Okay, so in other words, what we got price above the daily open first. Okay, that's the first thing we look for. And what I'll do, guys, is that I will mark out the daily open. So this is on a 15-minute chart, okay? But what I'll do usually is I'll go to a daily chart and I will mark out, or I'll go to usually a daily chart, or I'll go to an hourly chart and I'll mark out the daily open. Okay? That's the first thing I do. So if I'm expecting a bearish day, guys, I mark this out, because what this will do is that it will give you a visual aid on your screen showing you that price is now above a certain level, and that if you want to get short in the market, then this is the area that you need to be focused on. It's above that area, and it just helps, guys, okay? Especially when you're first learning. It's nice to see this visually occur, okay? So in this situation, guys, we got the previous day's high taken out, and then what we saw then was a breakdown below the daily open. So this was our entry requirement, guys. We could have got an entry from here. If you're really, really aggressive, then you could have got an entry from here. But what I would do, guys, is I would always wait for a retracement of some kind. So once price has taken out the the high of the day, or it's taken out liquidity out of the market, and I'm expecting a bearish day, what I'll do is I'll wait for the price to take out that high, and then I'll wait for a fractal entry pattern on a 5-minute chart, or even a 1-minute chart sometimes, but that's what I do, that's my technique, okay guys? But in this situation, it was good because we got quite a good bit of confirmation, okay? Price broke below the daily open, so it had already been accumulating and it broke below it, which means that, of course, you can literally just treat that like a market structure break, guys. It's the same thing, except this time we're using it with a different framework in mind. So price accumulated, it took out the high of the day, of the previous day. And then what happened is that it broke below the daily open, which indicates that it wants to go lower, guys. And what it did is it retraced back into that breaker there that sent price up to take the stops out of the previous day. So that would have been your entry requirement, guys. And after that, it's just a matter of targeting. Okay, guys, you know, we have a liquidity level here. And we also have a very, very big void that price, you know, wanted to fill in right here. Okay, guys. So these are our, you know, our liquidity concepts, you know, our low and a void. Those are the two most important liquidity concepts that we focus on, guys. And the key thing to remember here is that it's understanding the framework. Okay, it's understanding the framework. We got price rise above the daily open. That's our first requirement for a sell day. We've got to take out a high, and then we saw an expansion down, guys. And it's really that simple. It's just understanding what price is doing. Okay, guys, it's understanding what price is doing at any given point in time. So the reason why this would have been a good way to get an entry, guys, and the reason why I would usually wait for a retracement is because sometimes you can get price rise above the weekly open or the daily open, right? And you might not be right, okay? It's not every time that price is going to rise above the daily open and you'll be right for a sell, okay? What you really want to do is you want to wait for price to retrace or give you some sort of confirmation, okay? So I always had this marked out. Let's say let's say I was expecting the previous day to be, you know, bearish, right? Or let's say I was expecting bearish price action for the week ahead. I would have these levels marked out, but I would always wait for the confirmation. The confirmation is what's going to give you your entry requirement, guys, and that's how you're going to be able to use this technique that we're showing you. Okay, you must wait for confirmation when you're entering, but this is the same framework, and it's the same thing here, guys, okay? So if we look at this bit of price action here again, that was Tuesday's price action, this was Wednesday's price action, okay? And you really want to see, like, this works very, very well with understanding, like, the weekly bias and the weekly range, okay, guys? And what that basically means is that when we are trading, when we're intraday trading, we want to expect the high to be made on Tuesday or Wednesday, or Monday to Wednesday, really, okay? The high of the week is usually made on a Tuesday, but it can be Monday and it can be Wednesday. So in this situation, the high day was actually made on the Monday, and what we saw the high of the day was made on the Tuesday here, because we've got a stop run. This was Monday's price action. Price made the high of the week on the Tuesday, and we saw a distribution lower. So in bearish weeks, guys, what we want to see is we want to see the high of the day either made on Tuesday or Wednesday, or the high of the week either made on Tuesday or Wednesday. And this will give us a strongest setup. So once price took out the high, once it took out Monday's high, guys, that was the indication that, and then once it broke lower, that was a good indication that price most likely is going to be bearish for this week. Okay, and of course I was expecting bearish prices as well this week. So that is the reason why I would have been looking for sell positions, and that's the reason why I wouldn't be looking for bullish conditions, because I expected, you know, order flow to be bearish. I expected price to be bearish, guys, and this is what it comes down to, guys. Okay, you can only be using this framework in the right conditions. Trading is always about understanding what conditions the market is currently in, and then using the right tools for the right situation. I wouldn't be using these tools if the market was in a very range bound, in a range, you know, a very, very range bound market where there is no real order flow, there is no real trend. The market is just literally moving between highs and lows. I wouldn't necessarily be looking for this, but if the market is very bullish or it's very bearish, and you have your higher time frame, let's say you've got a higher time frame level marked out, a resistance or a higher time frame, the liquidity level marked out, then this is a very good technique to use, because you can use it let's say this was the high of the range. Let's say that was the high, guys, okay? And let's say this was a support level down here. Then, and you knew that price was going to be bearish inside this area, or you had a bias for price being bearish inside this area. This is the best time to use this technique, because what will usually happen is that price will play out in this format. It will have an accumulation phase and manipulation, and then what it will do is it will distribute lower. The same thing here, price accumulated, manipulation, distribution. Okay, guys? So, the main thing to understand is when you want to be looking for this technique, when you want to be looking for this. And the conditions for this setup is when price is either trending bearishly or bullishly. Okay, guys? Price must be trending in one direction or the other. And you want to be looking for this setup to happen usually on Tuesday or Wednesday. Okay, guys? Usually on Monday, what we'll get is we'll get a consolidation on Monday. We won't get much bias movement on Monday. Price will usually just run, stops either side of the range like it did. There's stops above there, buy stops, and there's also sell stops below here. As you can see, price dropped down, ran that area of liquidity below here, and it also shot back up and ran the buy stops above that level there, and it just continued and pulled back into the range. Okay. So usually what will happen on Monday is that you get like a consolidation, contraction kind of day. Tuesday, you'll either see price make the high of the week and expand, or that will happen on Wednesday. Okay, guys, but in this situation, we got a very, very nice expansion through on Wednesday also. And it's following the same bias, guys. Okay. All we're doing is we're looking at price in a certain structure, and we're saying, okay, if we're expecting it to be bearish this week, then what do we want to see? We want to see power 3 occur. We want to see price above the daily open. In this situation, it's here, and we want to see price accumulate above that. And this will usually happen, guys, in a particular time of day, but we will talk about that in another video. And we want to see price then give us some sort of confirmation that it does want to go lower. And in this situation, guys, we get a classic break of the structure low right there. That low was taken out, and then price retested a bearish block. And this is the perfect trade you can really get, guys. Okay, because number one, the bias for the week, which was bearish. Price has already given you some indication that it wants to be bearish today. Why? Because it's meandered around the opening price, and then what did it do? Dropped down below it, then went above it. Boom. And then what did it do? It broke the market structure, broke that low, and it came to retest. So you got a sell. You could have got a sell in here, guys, quite easily. So it's using the same technique. You could have got a sell here, just using your OTE setup, which is a break of market structure and a retrace back into that range right there. See. So you'd have been able to get an entry on the 79 retracement level right there, and you also price came into a block. Okay, guys. So understanding this technique, guys, will just help you to understand when to buy and when to sell in trending markets. And what I usually do is I will usually wait for some sort of confirmation, i.e., in the form of a retracement, and that will be my entry requirement. I'm not very aggressive with this, guys. I don't, just buy above the opening price or below it. I wait for price to give me the confirmation, and this is the key. You won't always get it, but when you do get it, it's a loaded deal, especially when you use it and you frame it around your high time frame concepts. What is the high time frame order flow, and where is price reaching for on a daily chart and a 4-hour chart? This intraday pattern will really, really help you guys out. Okay, so this is one thing I want to talk to you guys about today, but I also need you to understand the phases of the market. All right, guys. And what I mean by that is that you need to understand that when the market contracts and gets small, then you should expect expansion. Okay, it's as simple as that, guys. And this is a similar technique to this. Price is contracting here, then you see an expansion. It contracts, consolidates, and you see an expansion. Okay, this is more or less how the market moves, guys. And I wanted to show you this on daily chart as well, just so you understand that this process happens again and again and again. So this is a daily chart, guys, okay? So this is, it's not an intraday chart, it's a daily chart, but the same concepts are being applied here. So what we're seeing here is that this is the opening price of that month, okay, guys? That is the monthly opening price. What we see here is that we see price get above it slightly, and what it does is it drops below it, okay? So I'm going to show you the same technique that I was just talking about, except now we're using it on a daily chart, guys. So this phenomenon happens on every time frame. Okay, it can happen on every single time frame because price is fractal and price repeats itself, guys. Okay, so what I'll be framing this trade on, or the indication that this wanted to go higher, is price was bullish on a weekly. Okay, as you can see, price came up, made a higher, made a lower high, a higher low, sorry. And what it did here is that it dropped down and took out liquidity below that low. Okay, it took the money out of the market, and that happened once price was that happened in the first week, more or less. First, second week, price dropped below that level there and took liquidity out of the market. All right, guys. So in this situation, what do we want to be doing? We want to be applying the same techniques that we learned in the PO3 concept. We want to see price drop below the opening price, as it did there. And we want to see price either come into a bullish block or a bearish block. Let's say price is bullishly trending. We want to see it take out a low, which it has there, or we want to see it come into a bullish block or a bullish breaker. All right, guys. So in this situation, what price did is that it ran that low. So that's a very, very, very big indication that they're accumulating price. Okay, they're accumulating price below that low. So there was 100% orders for people that wanted to go short at that level. And what the market makers basically did is that they filled in those orders, right? So they filled in those short orders, and by doing so, they accumulated their own orders to go long on the market. So this was the accumulation, guys, and the manipulation, okay? Let's mark it out. The accumulation and manipulation happened here. Why? Because they manipulated price, taking it down below that low, and they accumulated their long positions there. That's why when price got above this level now, as you can see, and it closed above, then that was an indication that price wanted to seek higher prices. Okay, guys? And that's why we got an expansion to the upside. All right, guys? And I know you're saying, oh, but where if I was trading off a daily chart, where would I got in? Or like, where did my entry would have been? Your entry would have been that breaker right there. All right, guys? And the reason for that is because that is the last up candle before that low was taken out. So that was the down move, okay? So that was the last up candle that took out price there. So once price gets above it, that level should be used as support and price should seek higher prices. And it's as simple as that, guys, okay? So that was confirmation, that would be your entry point. But we're framing it on the same concepts here, guys, okay? It's the same liquidity concepts. Price takes out a low below the daily open and the weekly open. In this situation, it's a monthly open. And price accumulates below that level. Either comes into a block or takes out a low or high. And in this situation, it took out a low. And then once we see price get above that level, then we look for confirmation to go long. And in this situation, that was a confirmation, and boom. If you'd held that trade, you would have made, if you held it to that high, even though it would have taken a bit of a while, you would have made a good, 10.5 R on that trade, guys, okay? And this is why I like using breakers, because you get, your risk reward in them is so much better than it is using OTE blocks or using order blocks. Like, it's a lot nicer and it's a lot cleaner, but it just helps you guys understand what is really happening here, okay? And it's the same thing. We're using the PO3 concept to know when the best time is to buy, and then when to be looking for a retracement, and when to be expecting price to go somewhere. But you must frame this on what the higher time frame order flow is. And if you're trading this on a on a 15-minute chart, you're doing this intraday, you want to be looking at what that 4 hours chart is saying. Okay, you want to see what the order flow on the 4 hour chart is, because that's what's going to give you a good indication of where price is reaching for. All right, guys. So there's one more thing I wanted to talk about, which is small ranges, guys, and big ranges. Okay, like this is a very, very important factor. All right, it's a very, very important factor. And what I want you guys to understand is that this is how the market works as well. Like this will dog ear tail into what we just talked about, but the market works inside ranges, right? So, you know, you guys hear when price contracts or when it consolidates, you should expect an expansion. And that's more or less what is happening, you know, what happens all the time. When price is contracting, guys, when it contracts, what you should therefore expect after that is an expansion. And the reason for that is because when price is contracting, when it stays inside of a range, a small range, what it is doing is it's accumulating orders, okay? Orders are being accumulated, they're being stacked, they're being stacked, they're being stacked. And once that process has stopped, then that's when we get an expansion up. Why? Because the orders that have been accumulated inside that area of price, inside that range, inside that candle, you know, whatever it is, right? Whatever form the contraction takes, those orders need to be distributed throughout the market. And a good example of this, guys, is, you know, let's look at this candle here. So this is a very, very small range candle. Why? Because the trading day volume, right, is extremely small. Like this is, you know, it's a very like a doji candle. This is basically showing that the trading range, you know, price did have quite a big range from that high to that low, but the volume of that trading day was extremely small. So what that's showing is that price is being stacked in a very, very small area. So just understand, you know, if you don't take anything else from this video today, apart from the PO3 stuff, then take this. All right, small ranges always lead to big ranges, and that's why in this situation we've got a very, very small range there. Even though we did get a big range, I'm talking about the volume, guys. Okay, I'm not talking about the wicks. I'm talking about the body of the candles, the trading volume. We had a very, very small range, and that's why we had a massive expansion to the upside. You know, that day's range was extremely big, you know, almost 300 pips. So the reason for that is because we had a very, very small range day. Like this is the clue, guys. If you see price have a very, very small range day, like a very, very small body, and that happens, you know, one time, multiple times, expect an expansion, one way or another. Okay, guys. That's really the main thing to take from that. It's just that, you know, and this is called inside days. Okay, guys. Like the market will have inside days, more or less. What it will do is it will have days where price stays inside the range. So in this situation, price stayed inside the range of the previous day. In other words, it didn't take out the high or the low of that previous day's range. And it also had a very, very small body and a very, very small trading volume there. So when you get days like this where price stays inside the previous day's range, what's happening is basically there's liquidity being built up on either side of the market and price is stacking up orders inside that range. That's why you see an expansion up. Okay, guys, so you know, this happens time and time again, but when you do see these conditions and you're expecting price to continue bullishly or bearishly, then this is a very, very good indication that that is most likely going to happen in the next day or two. Okay, guys, that's why in this situation we've got an expansion the next day, but we could have got an expansion, you know, a couple of days after. But when you see these conditions in these situations where price is very, very contracted, you have a very, very small body of volume, and price stays inside the previous day's ranges, then that is a recipe for, you know, an expansive move, guys. And that's why you get moves like this which seem like they come out of nowhere, but there are always clues in price. Okay, price leaves clues always. So it's the same thing here. All right, when we look at the same thing here, like this is not as much of an extreme example as that, but what we have here, guys, is that price has stayed inside this range. Okay, so it stayed inside this previous day's range once it's coming to a bullish order block. All right, I definitely agree with that. But what's happened is that we have a smaller range. So that's a big range there, right? This is a very small range there. Okay, because the volume of that candle is small. All right, it's more about the volume than the wicks, but the wicks are important as well, because if they also indicate if the previous day's highs or lows have been taken out. But when you get these two conditions, guys, okay, when you get price staying inside the previous day's range and you also get a smaller candle, like a small candle, that means that there's some accumulation going on there. And as you guys know, accumulation, manipulation, and distribution. And that would be the distribution. Okay, guys? And you really want to just look out for that in your charts and understand when it's going to happen, why it happens, and just go through your charts to see this phenomenon. But I would say this stuff happens a lot on cable and fiber and the EM pairs. It happens a lot on those pairs just because those pairs are really volatile, and just because they're the most, they're the most heavily manipulated pairs, guys. Okay, these techniques that I'm teaching you today, you will find these techniques work extremely well on the pairs that are manipulated the most. And the reason for that is because this is a manipulation. This is a price manipulation, and this is one of the biggest pairs in the forex market. Is pound dollar. It's almost the biggest pair. Euro dollar is the biggest pair. With the most trading volume. So these pairs have extremely a lot of, have to have a lot of money going through them every day, guys. And that's why the market makers focus on these pairs. And that's why you see them being manipulated the most, because they have a lot of volume, a lot of trading volume. There's a lot of people trading these pairs, and they are the strongest currencies in the world. So in these situations, guys, these techniques will work very, very well when you know when to use them. Okay? It's as simple as that, really. But yeah, okay. So if you guys have any issues with this and you want me to talk and walk you through them and just give you a better understanding, guys, I'm always free, as you know. I'll do my best to kind of facilitate you, but just understand the concept and then start going through your charts. I think that's the best way to understand these kind of things. I can only show you so much. A lot of this is going to be coming from your own knowledge and your own experience and seeing what you can in a chart. But I hope you got something from me either way, and I will talk to you soon. Goodbye.